Imagine you own a brand new smartphone. Today, it's worth $1,000. But you know that every year a new model comes out and older models usually lose value. You believe that in 6 months, your phone will only be worth $700. Instead of hoping the price goes up, you are expecting it to go down. The same idea applies to derivatives. When you take a short position, you are betting that the price of underlying asset will decrease. Imagine a company enters a forward contract to sell 100 barrels of oil for $80 per barrel 6 months from now. 6 months later, oil is trading at $65. The company can still sell its oil for $80 because that was the agreed price. While everyone else is selling at the lower market price, this company is selling at the higher contract price. The fall in oil prices worked in its favor. Notice the difference between a long position and a short position. A person with a long position hopes the price rise. A person with a short position hopes prices fall. They are two sides of the same contract. If one side benefits from rising prices, the other side benefits from falling prices.